Leasing a car gives you a vehicle to drive for a fixed number of miles and months. It is similar to renting an apartment instead of buying a house. The monthly cost of leasing a car is often lower than buying it with an auto loan. Drivers save an average of $113 of monthly payment, plus drivers get to drive a new vehicle every 2 to 3 years, which makes leasing a tempting prospect. Leasing can lower your monthly payments, but it can wind up being costly if you don't pay attention to the fine print. Avoid these 5 common mistakes if you decide to lease your next vehicle. Number 1. Paying too much money up front. Car dealers advertise low monthly lease payments on new vehicles, but you may have to pay several $1,000s upfront to get that affordable payment. That money covers a portion of the lease in advance. Say, if the car is wrecked or stolen within a few months, your insurance company would reimburse the leasing company for the final value of the car, but the money you paid in advance likely would not be refunded back to you. You would be out of a car, and that upfront money you handed over to the leasing company would essentially disappear. It is recommended that you spend no more than $2,000 upfront when you lease a car. In some cases, it may make sense to put nothing down at all and roll all your fee costs into monthly lease payments. If something happens to your vehicle before the end of the term, at least the leasing company does not have a big chunk of your cash. Number 2. Not buying gap insurance. If you drive a leased car, you should pay for the gap insurance. The gap refers to the difference in what you still owe on your lease and the value of your car. Let me explain. Let's say your contract states that at the end of the lease, you have the option of buying the car for $13,000. If you total the car before the lease expires, your insurance company will determine the current market value of the car and pay that amount to the dealership, which owns the vehicle. If the insurance company says that the market value is only $9,000, you will probably have to pay $4,000 out of your pocket to cover the difference between the lease contract's residual value and the true market value, unless you have gap insurance. The gap coverage will cover this difference. Many leases include gap insurance by default. The dealer may offer to sell gap insurance, but you may also find a cheaper policy option with traditional insurance company. Regardless, the coverage is well worth the small investment. Number 3. Underestimating how many miles you will put on a car. It is common for leasing contracts to have an annual mileage limits of 10,000, 12,000, or 15,000 miles. If you exceed those mileage limits, you will be charged up to 30 cents per additional mile at the end of your lease. For example, if you exceed the mileage limit by 5,000 miles, you could end up owing an extra $1,500 at 30 cents per mile when you turn in your car at the end of the lease. To avoid extra charges, know your driving habits before leasing a car. Consider your daily commute and how often you take those long trips. If you know that you will probably drive more miles than the agreement allows, you could ask for higher mileage limits. However, that will probably increase your monthly payments because additional miles will result in greater depreciation. Number 4. Not maintaining the car. If your car has damage that goes beyond normal wear and tear, you could be on the hook for additional fees when it's time to return it to the dealer. If a car has a scratch, but the mark is less than the size of a driver's license or a business card, many companies may consider it normal use and probably won't charge a penalty. If the leasing company considers the damage excessive, it can charge additional fees. The definition of normal wear and tear can vary from dealer to dealer. Your dealer will inspect the car when you turn it in and look for dents and scratches on the body and the wheels, damage to the windshield and windows, excessive wear on the tires, and tears or strains in the interior. Don't assume that your inspector will be lenient. Before leasing a car, ask about the guidelines on the lease and conditions. These guidelines specify the types of damages you would have to pay for when you turn in your vehicle. If the car is significantly damaged, drivers can expect to be charged full market prices for the repairs. Number 5. Leasing a car for too long. If you lease a car, make sure that the lease period either matches or is shorter than the car's warranty period. Warranties vary from manufacturer to manufacturer, but they typically last up to 3 years or 36,000 miles, whichever comes first. if you keep the car for longer than the warranty period, you may have to consider an extended warranty. Otherwise, you could be responsible for maintenance and repair costs for a car you don't own while still making monthly lease payments. If you do plan to lease a car for an extended time, it's probably better to buy it. Use an auto lease calculator to figure out whether leasing or buying will save you more money over the long haul. Choosing to lease instead of buying a car can be a great way to drive a newer car with the latest technology and features for less money per month. But do your homework, shop around, and pay close attention to the terms and conditions to make sure that you get a lease that fits your driving habits and your budget.